right, everyone. Welcome to the 2024 Wilson Rogers and Company tax season update, as this is a client webinar. My name is Jared Rogers, and I primarily head up Wilson Rogers and Company. It is a co-owned firm practice company with my wife. That's the last name, Wilson, because we weren't married when we started. So there you go, a little bit of trivia. Just a little bit of housekeeping items before we get started. Everybody's video and audio is muted. If you do have a question, just hover in your screen until you find your control panel, and then you can just simply type it into the chat. We will go ahead and make sure that we answer all the questions that are sent to us when we get to that section of the presentation. But to be mindful of everybody's time, and given the fact that accounting and taxes is not sexy, we're going to try and keep this as brief as possible. All right, so what do we have on tap for the agenda today? First, we're going to go over some operational type of information, just everything about filing season, our pricing packages, and the personnel who will be assisting you for this tax season. We'll go over the tax law changes for the tax returns which are being filed 2024 in 2025. So what you need to know before you start your filing process. And then we're going to go over the top 10 tax tips and mistakes. So the do's and don'ts to keep most of the money in your pocket. All right. So the first thing that we kind of wanted to kick this off with, and I actually didn't remember this until very late, is that we are celebrating 20 years. So 2025 marks our 20th year in business. We started the business in September of 2005. So that's that. So in celebration, have a little image on the screen. And what is actually kind of interesting, if you take a very close look at this, you will notice that there are some oddities about it. Just to let you know, I literally had ChatGPT create this image by just giving it the prompt saying, hey, give me a celebration screen for celebrating 20 years. And this is what it came back with. The point of this is twofold. First, to indicate that AI is an amazing tool, but it's not perfect just yet. But point two, 20 years ago, I couldn't even do something like this. I would have had to have hired a graphic designer in order to get an image. So AI and tools and automation are impacting and changing everything for everyone, which is one of the reasons why last year we kind of shifted focus from what we call, what used to be our standard package, some of our more straightforward returns, because just to be honest with you, AI and automation will be able to do that very, very shortly. I would say probably like within the next 5 years. So what I usually tell people is if your situation is simple, you may not even need a tax professional because, you won't need a human in order to do your taxes in a few years. But needless to say, just wanted to let you all know that we are celebrating 20 years. Where did the time go? I actually do not know. All right. So let's get to the filing season data. So what are some of the things that you actually need to know? The IRS actually began accepting all business returns. So if you have a business entity that files an 1120, 1120S, 1065 tax return, those returns were starting to be accepted January 15th, which was yesterday. January 15th, also yesterday, was the last day to make any estimated payments for tax year 2024. So if you own a business, which, is a pass-through, or you own like a sole proprietorship, single member LLC, anything like that, and you traditionally owe at the end of the year or owe when the tax return is filed, then you're supposed to make estimated payments. The thing to know is that even if you didn't make estimated payments, there is one more payment opportunity, which is April the 15th, whether you do that as just a standard payment because you've already filed the return and it's been done, or you need to go on extension because the return cannot be completed by that time and file an extension payment. But the last estimated payment window is already passed. January 27th is the day that the IRS is actually opening up tax season. It will open up a 78-day window for over 140 million taxpayers to file their tax returns for 2024, which is going to cover any income that was earned from January the 1st to December 31st of last year. Okay. 78 days is not a lot of time. And this is why in our industry, people say, oh, this is your busy time. I say, no, this is my insanity time, because in that short window, we do a lot of the work, but we are a year-round practice. And unfortunately, 78 days is not enough time to get finished with all of the returns. So we end up putting returns on extension, which I'll talk a little bit about a little bit later in the presentation. January 31st is the last day for all companies to file their W-2s and 1099 NECs. So if you are a company that needs to issue W-2s and 1099 NECs, you can feel free to reach out to us. Our contact information will be at the end of the presentation. We can assist you with that. But if you are an employee or a contractor, just note that your forms are probably going to reach you around that time. They may come next week, the week of the 20th. I know that we've got some W-2s that we need to send out to various clients that we process their payroll for. But just be in mind, like the 31st is when W-2 should be showing up. So we usually like to say about the last week of January, but definitely the first week of February is about the earliest that anybody is really going to start filing, at least in our particular practice, in office. Important update: the deadline to file your return or extend it is March the 17th for any S corporations, partnerships, and multi-member LLCs. So all of those who could start filing on the 15th of January, the 1120s, 1120Ss, and 1065s, your deadline to file or extend is March 17th. Individuals and those that are C corporations, those filing on Form 1120, they have until April the 15th. Okay. Now, this has come up a couple of different times. I always like to reiterate it. An extension to file is not an extension to pay. What does that mean? You can file your tax, you can go on extension. So you can't get your return filed by the 15th. You say, hey, I want to file an extension, and both corporations and individuals can do that. So you go on extension, and you now, as an individual, have until October the 15th. As any one of those businesses, you have up until September the 15th. You get to September the 15th or October the 15th, you file the tax return, but you owe money. Then you get a letter from the IRS or the state saying, hey, you owe penalties. Why? Because the money is still due on April the 15th. So an extension to file is not an extension to pay. So if you believe that you owe and you're getting towards the end and you need to extend the return, let us know. We can work up some numbers. We can get what you've given us, analyze it, and determine how much you owe so that you can make an extension payment, because the penalties and interest only accrue on the outstanding balance. So hypothetically, if you owed $100,000, the penalty is running off of $100,000. Let's say that you get an estimate done to figure out, and the estimate is like, oh, you owe 98. So you pay the 98, and then you in actuality owe 100. You're only paying the penalty on $2,000 because you've already paid the 98. Make sense? All right. Last thing for operations, our season hours begin 9:30 a.m. to 7 p.m. during the week, and 9 a.m. to 5 p.m. on Saturdays, the week of the 27th. So when tax season starts, we will move to season hours. Those hours run only through April the 15th, and then we move to off-season hours, which is what we're currently in, which is Monday, Wednesday, Friday, 9:30 a.m. to 5 p.m. Central Standard Time. Due to the fact that we get extremely busy after March the 1st, everyone is encouraged to file early. We'll go over some discounts and incentives for you to do so. Returns submitted after March the 15th have a very high probability of having to be placed on extension. It is important to note, especially if you're a new client, we work tax returns on the first in, first out basis. We usually start getting jammed up February the 14th because you'll see in a minute, that's when our largest discount is. So at that point in time, we're starting to stack up anything that's coming in after that. And then there's a March 17th deadline for the corporations. So by the time we get to like April, you could very well be behind a couple of hundred returns, and most of them are not straightforward. So they take time to work. And once again, we work them first in, first out. The point of this is, if you would like to get your taxes done soon, submit as early as possible. All right. So let's go over some other items to note. If you are a new client and you are watching this, the process that we use to start tax preparation is basically as follows. We have a conversation, or you interact with us. We'll send you the information to go ahead and get started, including your access to the client portal. The client portal is the preferred method of getting information. Yes, you can drop it off. Yes, you can go ahead and you can scan it. We absolutely 100% do not accept tax return documents via email. So if you've got like personal information, don't send it to us via email. We're going to delete the email, and we're going to email you back and saying like, hey, submit it through the portal. Non-personal information, an Excel sheet or something like that, or a response that can come back, but actual tax documents, no, goes through the portal. So what happens is we'll set you up with the portal, and then we start the process when we get the following: a completed organizer, which tells us all your demographic information, name, date of birth, social security number, how much you made, et cetera, et cetera. You load your documents to the portal, and then you send us a message, whether it's through the portal, which is preferred, or an email saying that you are ready to go. Once you start loading documents, you're going to get a message from the portal saying, hey, we received your documents. We start when we get these 3 things. But once you send us that you're ready to go, we then go ahead, prepare the return. The preparer will ask any questions. We review the return. We present the return to file, and then we file the return once we have signatures and payment. So it's just important to know, sometimes we get the question, have you filed my return? If we do not have signatures and payment, both items, we will not file the return, okay? So you can send us the signatures, don't pay, doesn't get filed. You can pay, we don't have signatures, don't file. It's just requirements. We can't file a return without the authorization from you. Next up are 100 Days of Tax Tips, aka hashtag 100dot, which is our social media campaign. Started on Monday, January 6th, and it runs through April the 15th. Our January newsletter and our client organizer was sent out via email on January the 6th. So if you need us to resend that email, it has all the links to everything that you would need. Just email the office. Contact information is at the end, and we'll get that over to you. If you are a business and you are hearing about this whole BOI, beneficial ownership interest report, for those that owned LLCs, corporations, multi-member LLCs, etc., which, carried with it a hefty fine for not filing by the deadline, which was December 31st of 24. It was like a $500 per day penalty for not doing it, which is why you see that image in the lower left. It says, don't get fined $10,000. The BOI requirements are temporarily suspended due to a court injunction. So there was a court injunction, then there was an appeal, and then that appeal said that we were supposed to file, but then they reversed it. So ultimately, just realize that, the BOI reporting requirements still exist, but there's no penalties if you don't do it. If you want to know more about how to complete the BOI report, then you can check out the video on our lower left, which is on our YouTube channel. And then we also created the video on 10 things you can do to get ready for tax season, which is also on YouTube. So that's on the right. So packages. So this information was contained in that email from the 6th. These are our current packages. Left-hand side is all individual. Right-hand side is all corporations. So our baseline package is $530. And then our advanced package is $850 plus. What's the differential between the two? Basically, it comes down to if you have a business or if you have rental properties or if you're claiming the earned income credit. So standard will include a business that has less than $5,000 worth of income and expenses, a Schedule E, or if you have a single rental property, or if you have dependents, et cetera, but you're not claiming the earned income credit. That's a standard. Advanced is going to be any businesses that file Schedule C that have greater than $5,000 worth of income and expense, those that have multiple rental properties, or if you are claiming the earned income credit. Okay. And then there's just some add-ons that are displayed below. If you need to get tax projections, if you dispose of a rental property, et cetera. And then the pricing for corporate, 1075 is our baseline, and that basically covers up to $250,000 worth of revenue, less than $1 million or $1 million in assets. You're $1,600 plus if you have more than $250,000 worth of revenue. If you have a rental property, and then we can customize prices. We can customize prices with revenues in excess of 750 or any of these that do not have completed financials. Okay. There is a K1 add-on if you have an 1120S or a 1065. And then if you are looking to elect S Corp status, that's via filing form 2553. It's $315 if it's timely, which means 2 months and 15 days after the election is to be effective. So for example, if you're looking to have an S Corp effective January 1st, 2025, the deadline to file and be considered on time is March the 15th. But if you needed to do a late election, say you started a business in 2024 and you had a bunch of revenue and you're looking to potentially save money on taxes, the S Corp route might be the way to go, but that election is late. That's $630. Okay. Now, some of you who've been clients are going to say, well, wait a minute, that looks like it's a little bit more expensive than it was in the past, and you would be correct. But we also index our discounts. So our discounts are done the exact same way. So we have what's known as the filing season discount. Clients receive either $65, $55, $45, or $35 off their bill when they start the filing process by February the 14th, March 14th, March 31st, and April the 15th. After April the 15th, there are no discounts. There are some affinity group discounts if you are a member of a Black Greek letter organization or a member of XXX Racing. And if your income is below the free file threshold, which we'll go over in just 1 second, there's additional discount. Our largest discount takes place on Love Day. So get and give some love and submit early. The other thing to note is that there is this provision in our engagement letter called the extension surcharge. And what that reads is returns that are placed on extension and are not completed and filed by June the 1st will be charged the full package price, i.e. no discounts, plus an additional 50%. Only delays caused by extenuating circumstances will be exempted, and that's at the sole discretion of management. What does this even mean? It means that if you go on extension and we're asking for information and that return is not completed by June the 1st, we have the ability and the discretion to basically upcharge. Now you say, well, why is that? I will give you the very honest answer. This happened because there was a particular client that didn't want to file on time. We were chasing all throughout the summer. We got to October the 15th, then they pop up so they can file on the last day. Okay. The return rejected and could not be e-filed. So there was an issue with it. That return had to be mailed. Otherwise, they were going to be facing significant penalties because they owed a lot of money. Okay. Remember, you don't file a tax return by the due date. The penalty for late filing is 5%. And it goes up by 5% each and every month until it caps out at 25%. So if you file a tax return late and you're 5 months late and you owe $100,000, your bill just now went to $125,000 because you owe a 25% penalty. So us being the good, professionals not wanting this individual to get a penalty, drove the tax return down to the post office, which is 10 miles away. So they would be considered on time. And after that, I said never again. So the thing is that if we are the heaviest staffed during tax season, we keep on a crew a little bit later. But after about June 1st, we're moving into a full skeleton crew. And no joke, I don't want to get calls, while I'm on a cruise with Disney trying to celebrate my daughter's birthday saying, hey, I need a tax return, because I don't have the ability to send it. And nobody's in the office in order to do it as well. Okay. So the main thing is if you go on extension, just be timely, mindful of any communication, get the information to us. Otherwise, just realize that this can happen. Now, if it is extenuating circumstances, health reasons, divorces, something that's keeping you from getting the information, we're not going to penalize that. But if we're asking for the data and we're just not getting responses, then just realize that this can come into play. All right. Last operational update for 2023. These are the people who you will be interacting with. Angelique Tate is our administrative assistant. Kat Sarabia is our data entry workflow coordinator. We are doing something a little bit different this year. We are using automation to try and speed up the process. We have had issues in the past with getting returns completed timely, part of which is because the data comes into us later and we deal with a lot of more complex returns. So, it takes a lot of time to work those returns. But we're going to use automation this year to kind of like screen some of those W-2s, 1099s, any tax documents that you get, we can get pre-populated into the software, which should make it faster for other people to work the return. We got Sophia Seja, who is a tax intern, and Min Chao Pham, who is our tax intern. Both of them are students over at St. Xavier University, and they're accounting students. We've had our internship program since maybe the year before COVID. So it's been 2019, I believe. So quite some time. And we've had many fine accounting students run through here. And they always do a very wonderful job. Robert Williams will be joining us as the lead tax associate. So he will be in the office every day. Toya Simmons is a tax associate. Toya's been with us for 3 years. She'll be joining us, on a more limited basis. And then Mark Daniel joins us as an accountant and a tax associate. Mark will be helping with bookkeeping items, but he also does have a tax background, so potentially helping with tax returns as well. All right, let's go into the tax law changes for 2024. And of course, once again, this is accounting and tax related stuff. So we will try and be very brief and not bore you to death, but give you the important highlights. All right, first thing up, the IRS always indexes or increases certain amounts from one year to the next. The most important is the standard deduction. Okay, so on the left-hand side, we have the standard deduction for if you're single, $14,600, or married filing separate, married filing joint, or qualified surviving spouse. So widower, widower, $29,200, and head of household is $21,900. Okay. Why these numbers are even important is because this is the threshold for an individual to file a return. Meaning, if you're single and you made less than $14,600, and this is an important and, you did not have taxes taken out of your paycheck, then you don't have to file a tax return. Why? Because you don't have a filing requirement. Okay. Now, if you did have money taken out of your paycheck, so let's say you're a student, college student, something like that, you work a job, you make $10,000 and you had $500 worth of federal taxes withheld, the only way that you get that $500 back, because once again, you're below the filing threshold, you don't have a filing requirement, is to file a return. That's how you get the refund. Okay. This does not apply to 1099 income. So sometimes there's a misconception. People are like, oh, I didn't make 14,600, but you had a 1099 NEC or something like that. You have to file a return if you have over $400 worth of income, not 600. That is a requirement for 1099s to be issued. If you earned more than $400 via self-employment, Uber, Lyft, Rideshare, DoorDash, selling items, Poshmark, Etsy, anything like that, you have a filing requirement. But if it's all W-2 and you're under these amounts, you don't have a filing requirement. Now, the standard deduction is also the threshold for where you determine whether or not you want to itemize. So if you're an individual, you say, oh, I want to itemize. Itemization means exactly this. If you have expenses related to medical expenses that exceed 7.5% of your income, state taxes taken out of your check, real estate taxes that you've paid on your principal residence, personal property taxes. There are certain states like Connecticut that charge a personal property tax. I own a motorcycle. They tax the motorcycle every year. Okay. Mortgage interest, points paid on a mortgage, charitable contributions, whether they're in cash or they're in goods. If you're single and all of those things total up to more than 14,600, you would itemize on Schedule A. Married filing joint, you got a house, you pay a lot in mortgage interest, lot in property taxes, it exceeds $29,000, you're going to itemize. If you're very charitable, I have a couple, they give $50, $60, $100,000 easily, they're going to itemize. Okay. So just realize the standard deduction determines two things for you. It determines one, if you need to file a return, and then two, if you're going to have to go through the exercise or want to go through the exercise of itemizing. All right. And just realize that if you're 65 or older, you're blind, then you get an additional adjustment. And then dependents. So if a dependent is filing on your tax return, they get the standard deduction. Their standard deduction is the greater of $1,300 of or $1,300 of earned income, or sorry, it's the greater of $1,300 or it's earned income plus $450 up to the regular standard deduction. So once again, if you earned $10,000, your standard deduction would be $10,000 plus the $450, and it basically goes up to the standard deduction. At the end of the day, you can get no more than $14,600 as a single individual. Personal exemptions don't really apply, but if you have somebody who's living with you that you want to claim as a dependent and they are not your child, so like a niece, nephew, somebody like that maybe, you're supporting, they can qualify as what is known as a qualifying relative, but as a qualifying relative, they can't have income over $5,050. So if they earn income, say like $3,000, they can still be your dependent. But if they earn like $7,000, they can't be a dependent on the qualifying relative rules. On the screen, we've got the standard mileage rate. So if you're a business and you file a Schedule C, self-employed, the business mileage deduction is 67 cents. If you drove for charity, volunteering, anything like that, it's 14 cents. Once again, you would have to itemize. The depreciation component of the business rate is 30 cents. And if you drove for medical, like go to medical appointments and stuff like that, it's 21 cents. Earned income credit. So the earned income credit is a credit to individuals who do not make a substantial amount of money by IRS standards. They get an additional credit. So just realize that if you are single, head of household, or qualifying spouse, and you have no children, if you earn under $18,591, you might be able to get the credit. If you have one child and earn less than $49,000, you can get the credit. Two children, $55,000, and then $59,000 if you have three. You don't get any additional credit for anybody for having more than three children on your return. So if you have a large family, 6 children, 5 children, or something like that, the earned income credit is only going to apply to the first 3. Married filing joint, those numbers are 25,000, 56, 62, and 66,000. Right below that, we can see what the maximum credits are. So for single head of household and qualifying surviving spouse, no children, the max credit is 632. One child, it's 4,213. 2 children is 6,690, and 3 children is 7,830. So the maximum you can get on the earned income credit is $7,830. But if your the main thing is that if your income is below those limits, then keep in mind and bring that up to your tax preparer. We're automatically going to know and figure out the credit is kind of like automatic. But the thing to know is just that you qualify for the credit. If you are sharing this information with someone, just make them aware, like, hey, if you don't earn a lot of money and you have children, you may qualify for this credit. If you are a parent and you have a dependent and you are paying for childcare, just realize that you can get a credit for that dependent care. The dollar limit is $3,000 per child, and you can't claim basically any more than $6,000 worth of expenses. So if you're paying for daycare and you pay like $7,000 for your kid, daycare, and you only have one child, the dollar limit of the credit is calculated based off of $3,000, and then it factors into your income. So, for example, if you took $3,000 and you earned over $43,000 in the lower right, you get 20% of that credit, which would be $600. Okay, so the maximum credit that you would get per child is $600, but it's a very beneficial credit for those who qualify. All right, tax law changes continued. One of the things that I often like to highlight is that there are ways for individuals to file for free. So once again, feel free to share this information with your clients because it can benefit them. So the IRS has 3 ways for you to file for free. There's a program called IRS Free File. This is software. So you basically go to the IRS's website, and there's software providers that if you make below, I want to say it's 66,000, then you can, actually, I think it's 80 something thousand. Then you can file for free using software. IRS Direct File is the IRS's pilot program of their software where you file directly with the IRS. It is only the federal return. So if you need to file a state return, they can point you into the direction of how you can file that state return for free. But just realize that IRS Direct File is available. It's 100% free. However, it is limited to 25 states. Last year was piloted in 12 states, and this year is 25. And this year, Illinois was added to it. And then the other option is the VITA program, so free in-person assistance through IRS volunteers. So that's IRS VITA. So just once again, that's information for you. And also, this image was also created via AI. So I told ChatGPT to go ahead and give me the information on the 3 filing programs and give me a graphic, and this is what it came up with. So once again, just kind of highlighting that, AI is on its way. We did a video on our YouTube channel, which was, do I need to file a tax return? In case you all have not visited our YouTube channel, that is my alter ego, Roscoe. Roscoe gets all of his tax information off of social media. So just letting you know that, we did a video where Roscoe called into the office and asked whether or not he needed to file a tax return, and we kind of went over the filing thresholds. But once again, if you want to share any of the information with anybody, just go ahead and you can share that video with them as well. All right, continuing with our tax law changes for 24. This screen is showing something related to Form 1099-K. All right, and you may have heard some rumblings about this. Their payment processors such as Cash App, PayPal, Venmo, etc., that people can exchange money between one another for either services or just peer-to-peer, like, hey, somebody says, hey, give me $50 on the restaurant bill that we went to. Oh, yeah, I'll Cash App it to you, or I'll do whatever. There's a form that gets issued called a 1099-K that reports that income or what should be income to the IRS. The filing threshold used to be much higher. It used to be like $20,000, but there were some law changes back in like 22 that were proposed to bring that threshold down all the way down to $600. The problem with that is that the IRS has kept pushing this years and years and years. So that threshold has not been fully implemented. But what you see on your screen right now is what the timeline is for them to get to the 600. So in 2024, there's a $500,000 threshold, meaning if you received more than $5,000 through any of these peer-to-peer cash networks, you're going to get a 1099-K. Why is that important? Because if you don't report it on your tax return, you're going to get a nasty letter from the IRS. And then clients will call their tax professional and be like, hey, I got this letter from the IRS saying that I didn't report my income. And then we go, well, what did they say? Did you get? Oh, it was this 1099-K. Did you give it to us? No, I didn't give it to you because I didn't think it was important. And it's like, right, that's the issue. Okay. So the main thing is that we want to make sure that all income is reported on your tax return. So in order to do that, just realize if you received money through any payment network, just let us know. Doesn't make a difference what the dollar amount is. Let's say you are selling goods on Poshmark or Etsy. Well, let's use Poshmark. Poshmark. So you're selling goods on Poshmark. I got older clothes and things like that, but they have value and I want to resell them. But I'm not selling them at a gain. I'm selling them at a loss. I paid $100 for these gym shoes. I'm selling them for $30. It's like an online garage sale. Okay. But at the end of the day, if I did that and generated over $5,000 worth of transactions, then I'm going to get a letter. I'm going to get a 1099K that I need to put on there. Now, how do I report that? Me personally, I list the $5,000 worth of income and I say that my expenses were $5,000. I just net it out to zero and that's it. The IRS is happy. They can see that the 1099 has been reported on your return and you're not generating a loss for tax purposes, so they're good. All right. In 2025, that threshold is going to be reduced to $2,500. In 2026, we're going to be at the $600 threshold. Okay. So once again, just realize, per the American Rescue Plan Act, that's where they were originally going. So if you have income, short version is make sure that we know about it. All right. 2 credits that apply to those who have homes. So many people are aware that, if I put some type of energy efficient anything in my home or whatever, that I might qualify for some type of, tax benefit. Those 2 credits are the energy efficient home improvement credit and the residential clean energy credit. So the energy efficient home improvement credit is broken out between home improvements and then property expenditures. So just realize if you bought exterior doors, the credit is $250 per door and $500 in total. If you put in windows, $600, insulation, $1,200, home energy audits, etc. Central air conditioners, $200 per item, heat pumps, $2,000. And then, you have maximum credit, combined annual credit of $1,200. The excess credit does not apply or carry over. And then the biomass is $2,000. If you did residential clean energy, that's going to be like solar electric panels, solar water, wind turbines, geothermal, all that stuff. You get 30% credit or whatever it is that you spent. Okay. There's no combined limit. Any credit amount that exceeds the tax liability carries over to the following year. So the main thing to know is that if you installed some type of energy efficient item, once again, just let us know. You can feel free to take a picture of this slide, but just realize that we are going to send out a recording of this presentation, so you'll be able to review it as well. Next credit relates to EVs or electric vehicles or hybrid vehicles. So EVs being full plug-ins, and then the hybrids makes sense, gasoline and electric. So there was a new credit that was put in place. I want to say it was like 2 years ago. That's available through 2032. It's $7,500 for a new vehicle and up to $4,000 for a used clean vehicle. Beginning in 2024, you could choose if you wanted to take the credit on your tax return or as a discount at the dealer. So if you've already taken it, you bought the car at the dealer and they say, hey, we'll give you a $7,500 credit, as an incentive to buy EV. Just realize you're not getting anything on the tax return. But if you did not take the credit at the dealer, then realize you could get it on a tax return. You just need to highlight it to us. The expense, how expensive can the vehicle be? If it was a new SUV, van, truck, the retail price had to be below $80,000. If it was a new car, it had to be below $55,000. If it was a used car, the retail price must be less than $25,000. There is an income limit. New vehicles, it's $150 single, $225 head of household, and $300 married. And a used vehicle, your adjusted gross income must be below $7,500 single, $112,500 head of household, and $150, married. So for all those who are trying to be environmentally friendly, you potentially get a credit. So just keep that in mind. Last up, in terms of the tax updates, for all my retirees. If you're a retiree and you have things like, IRAs or 401ks, 403bs, Roth accounts, etc., you're required at a certain age to take what is known as a required minimum distribution, or RMD. So years ago, that used to be 69 and a half, but there were some changes based off of the Secure Act 2.0. So the RMD age has been moved to 73. So in the year that you turn 73 is when you have to start taking RMDs. We don't necessarily calculate that. That's done with your retirement plan administrator. There were simple Roth accounts were brought into play, and these is all in 2023. The RMD penalty was lowered. So if you don't take an RMD, then you potentially are penalized. So they lowered the penalty. And then 50K QCD, which is a qualified charitable deduction to charitable trust, gift, and annuity enhanced tax credits for startup plans. In 2024, you can now do the items that are listed, but the most important is that there are no RMDs required for Roth 401ks down at the bottom. There's no 10% penalty for taking money out of a retirement account for an emergency, domestic abuse, terminal illness, and then there's also employee emergency savings accounts. In 2025, they're going to increase the catch-up contributions that you can make into a retirement plan. And by 2023, the RMD age will be raised all the way up to 75. Okay. So that's the tax update side. Let's move into the very last piece of the presentation, which is what we deem the 10 top tax tips and mistakes, the do's and don'ts to keep the most money in your pocket. This is basically like tax planning. And this is based off of, literally like 20 years worth of being in the business or in the industry and seeing where people potentially lose money. Okay. So let's start with the tips. The first thing is to maximize your retirement contributions. If you contribute to any type of tax advantage retirement account, you got a 401k at work, you have an IRA, etc. Contributing to those things, especially like the pre-tax items, 401k, 403b, etc., helps lower your taxable income and you can save for the future. So it's a win-win. Okay. And for anybody who owns a business, self-employed or has like an S corp, etc., retirement contributions are one of the best ways and one of the easiest ways to like lower your tax bill. So for example, there's a thing called a SEP IRA. Okay. And the SEP IRA allows you to contribute a massive amount of money to your retirement account, but it is limited. It's based off of the income that you have in your actual business, the profit. And then depending on the structure, there could be a W-2 component. So for example, if you're self-employed, it's just based off of the profit that's shown on the Schedule C. If you have an S corp, it's based off of a maximum of 25% of the wages that are shown on your W-2. But here's the cool thing. The limit is like $69,000. So you can contribute up to $69,000 using a SEP if you have a business to your retirement account, and it counts as an expense on the tax return. So it lowers your taxable income, and you're also building for retirement. Being in this business, we get to see everything. So we get to see everybody's life through the scope of taxes. We get to see when you have children. We get to see when you send them to college. We get to see when you don't have children anymore. We get to see when you are potentially going through a divorce, or when you are divorced, or when you're widowed, you name it, or retired, or, illness, whatever. We get to see it. So when we get to the retirees, we get to see those who, just have Social Security, those who maybe have a pension, because their entity still offers a pension, such as like the Chicago teachers, or most of the state pension. And I can always tell when somebody worked for Chicago public schools, because their pension amount is usually a lot higher than the average retiree, and I've seen people who, have $1 million in retirement assets, 2 million, 5 million in retirement assets. So if you think about it, if you have like a SEP IRA and you have a business and you contribute like $69,000 over the course of 10 years, that's over $500,000 in retirement contributions. Add on to that the compound effect of the growth, you could easily get to $1 million in theory. I'm not a financial advisor, so I don't want to speculate, but it's quite possible that you could generate up to $1 million in retirement assets. And you'd be surprised. So if you take that and you say, okay, if I retire and I have $1 million, what are you going to be spending your money on? Let's say that you spend $100,000 a year. Well, $1 million is only going to last you 10 years. If you spend $50,000 a year, that retirement money will last you 20 years. And that's one of the things that we're just trying to highlight is that, retirement, you don't know when at some point in time, you're going to not want to work and you're going to retire. There may be Social Security, there might not. If you were self-employed, you were a barber, hairstylist, something like that. If you filed your Schedule Cs, you contributed to Social Security, so you might get some money, but, you might not have as much as you would desire for the type of retirement that you want to lead. So anyway, maximizing retirement contributions is one way to lower your taxes. Keep track of your deductions. This is one of the ways that people lose a lot of money because they don't keep track of, like mortgage interest or medical, how much they spend on, say, like medical expenses, if they pay like local taxes, et cetera. So just keeping track of your deductions. In the video that we talk about the tax season game plan, we talk about the 10 tips, and this is one of them. Claim all the eligible credits, so look into credits like the earned income credit, the child tax credit, any education credits that you're paying, school for like, your dependents, American Opportunity Credit, lifetime learning credit. We automatically look for those things when we're preparing a return. But, say like you bought like a hybrid, we're not going to know that, so just say, hey, isn't there a credit for like buying a hybrid? You're going to want to review your filing status. You're going to want to choose the status that maximizes your tax liability. realize that you are locked into the status that is appropriate for you. So if you are married, you generally can only go married filing joint, meaning file together, or married filing separately. Those you can't go single. Okay. Single is no longer an option when you're no longer single. You are not legally single if you were married by December 31st. Now, and that's an important thing to know, is that your filing status is determined by your marital status on the last day of the year. So let's say you were married at the beginning of the year and you got a divorce by December 31st, you now no longer qualify as having to go married filing separate if you were not filing with your spouse. You can now use single or potentially head of household. But for example, when it says, choose a filing status that minimizes your tax liability, somebody who was married, but they've been estranged for their spouse for the last 6 months of the year, may actually be able to use head of household, and that's going to be more favorable. So we automatically look at filing statuses, but you just want to make sure that you're choosing the status that is best for you. If you have a business, you want to make sure you're deducting all the business expenses. So for self-employed individuals, deduct all allowable expenses like home office costs, equipment, travel, etc. Or you want to stay organized with your records. So maintain records, of your receipts, your charitable donations, any tax related documents, ensure accurate filing, and being prepared for an audit. People will always tell me, they're like, hey, I got these receipts. Do you need them? I say, no, we do not need your receipts, but you need the receipts in the event that you are audited. Okay. So you just want to make sure that you're keeping good records. In that video, that same video on tax tips, if you put things on a credit card, go back and look at your year-end summary, because you may have forgotten that you made a charitable donation because you did it on a credit card. Or, look at your bank statements, because you got things like that. Or there's medical that you may have paid out of pocket. So you just want to make sure that, you're staying organized, keeping a record. And right now, given that it's January the 16th, now is the opportune time to go and look for all those things, because this filing season has not started yet. So you still have time to search. You potentially want to defer income. So if you can postpone income into the next year if possible to reduce taxable income for the current year. So for example, if you're self-employed and you have a business, and you have the option to invoice a client for work in December, based off of your accounting method, meaning cash basis, and you're not pressed for the income, you just say, hey, just pay your invoice next year. Okay. That pushes the income into next year, which potentially lowers your income for this year, which could put you in a lower tax bracket. If you have stocks, harvesting tax losses, so you want to offset gains by selling underperforming investments to realize the losses, which can reduce your income. So if you have a stock that performed really, really well, but I had like this one stock, I think it was a real estate investment trust, a REIT stock, and it just did horribly. And it's not coming back because corporate real estate right now is not doing really well because post-pandemic, people aren't in offices. So the stock tanked from a stock price, I don't remember what it was, but it just made sense just to sell it. And I can use that to offset any stocks that I sell with a gain. You also want to make sure that you're chatting with your tax professional often. So you want to consult with your tax pro to navigate complex tax laws, especially if you have changes in life or levels of income. So if you lost a spouse, you got married, got divorced, had a baby, lost a baby, unfortunately, anything that's going on from a life standpoint or income, got a new job, got a significant bonus, you just want to talk to your tax professional so they can tell you what that impact may be and you can plan for it. And it also applies to significant transactions like sales, in particular, like sales of real estate, rental real estate. So, if you inherited a property from your parents or something like that, and you all are going to sell it, or if you had a rental property and you're going to dispose of it, talk to your tax professional, because the last thing that you want to have happen is you get some money from a sale, you go spend it, you file your tax return, and then you figure out that you got a $50,000, $60,000 tax bill, which you could have paid had you known that you were going to have it, but that information wasn't given to you because there was no interaction with the tax professional. Then it's just not a pleasant place to be. But I had a client, they did sell a property, they had a $60-something thousand tax bill, and they had retained like most of what had actually been garnered from the proceeds. So they actually knew and had the money to do it. And the last tip that we have is, even if you owe, file on time. Avoid late filing penalties by submitting your return on time. Even if you owe, the IRS offers payment plans to help you manage your balance. So you either want to file by April the 15th or file by the extension. Once again, the penalty for not filing, which is the heaviest one, is 5% of the balance per month up until 5 months, and it caps out at 25%. So if you know somebody, they look at their taxes, they're like, oh my gosh, I owe X amount of dollars. The wrong option is to not file it. the better option is to file it because me, myself, being a CPA, I am licensed in the state of Illinois. I represent taxpayers before the IRS and the state when they have a balance that they cannot fully pay. We're currently working on somebody who owes $198,000 and we're getting them into a payment plan. And the payment plan, I think, is going to be $2,600 a month. Okay. Everybody's situation is unique, but the main thing to know is that you want to make sure that you file your returns because there's always a way to deal with the balance. Top 10 mistakes. So you want to avoid these things and you will keep more money in your pocket. First, the flip side of reviewing life events is not routinely reviewing any corporate life changes into the tax return. So, for example, if you're going to have a kid that is about to roll off, finish college, not be a dependent, it could change your filing status. You might not, if you're a single parent, you might not be head of household anymore. You might now be single, which puts you in a different tax schedule, which means that you could potentially owe. So just making sure that, somebody is aware of life events so they can help you plan for it. Claiming the wrong filing status. So claiming head of household versus married filing separate, you may not qualify to file as head of household. And then being a tax professional, I know all types of shenanigans that are pulled. So sometimes people file that, but they're really not supposed to file that because they're legitimately married and they live with their spouse. Yeah, no. So claiming the wrong filing status, claiming ineligible dependents. There are people who have been told, oh, I can claim X, Y, and Z person, but they really don't qualify because, for example, like that one that we said, qualifying relative, they're like a niece or a nephew, but they make like $20,000. They're above the income threshold to be claimed as a dependent. Filing with a name that doesn't match your social security number. This typically happens when, and I'm not being stereotypical, but it does typically happen when a woman recently marries or divorces because the name that is used on your tax return must match what the Social Security Administration has. So, for example, me and my wife, her last name was Wilson. So Aranita Wilson. So once again, that's the Wilson Rogers. So she gets married and she doesn't change her name with the Social Security Administration, right? We get in January, we're getting ready to file the tax return. What's her name on the tax return? Is it Aranita Rogers or Aranita Wilson? It's Aranita Wilson because it's not been changed with the Social Security Administration. And the IRS matches up what's known as name control, which is the first four letters of the last name along with the first five of the Social Security number. That's the name control. So if the return says ROGE, it has the number, but the Social Security number has WILS and has the number, then it's going to reject. But I've been doing it long enough to know that when we have a reject, it usually means that somebody's name isn't correct. It could also be that we don't have the right Social Security. We don't have the name according to the Social Security card. So sometimes people don't like their name, their legally given name or their government name. So they will go with a different name, and that's what they use on all their documents. We go to file a tax return, and then we find out that that's not their legal name. We actually had a taxpayer where one of their children was adopted, and their last name was never changed with the Social Security Administration. So when we tried to file the tax return, it didn't work because the name was different. So just be advised, filing with a name that doesn't match your Social Security number is a mistake, and misusing or not using the earned income credit. So once again, if you believe your income is low enough and it applies to you, then you want to potentially get that, or at least let your tax professional know. Other mistakes: failing to claim points paid to refinance the mortgage on your residence. So if you refied and you paid points, the points are usually on a 1098, but just highlighting that. Inappropriately double dipping with regards to reporting expenses. So you paid expenses with pre-tax dollars, but then you're trying to claim them on a tax return. That's just inaccurate. Sometimes people do it, but they're not aware that they're not supposed to do it. Forgetting about interest and dividends. So, banking, interest and dividends, which is not, interest rates aren't the greatest. So, but they're higher than what they were, during the pandemic and previous to that. So banking interest, people are getting more bank interest, but there's a threshold. People forget like, oh, I even had this interest that I got. And then they don't report it. And then they get a letter from the IRS saying, hey, you failed to report this $100 worth of interest. Sometimes if you get if you open up a new bank account and they give you that incentive, like, oh, get $200 for opening up a bank account, the bank actually reports that as interest via 1098 INT. So you just want to make sure that you're reporting all things like interest and dividend. Losing receipts and other important documents, once again, helps you in the event that you get audited. The IRS will ask for proof, or just keeping track of things that you have. And then failing to report all your income. That kind of goes to the 1099K thing. Just making sure that you report the income that you received. Sometimes people have this misconception. Oh, I got paid in cash. It's not reportable. Yeah, usually it is. Or, I got paid under the table. There's no such thing in the IRS's world. Or failing to report 1099Ks, et cetera, things like that. If you do need more tax tips, we've got two different options for you. The first is to head on over to our website, wilsonrogers.net. If you click blog right up here in the top, you'll be able to see all the various blog articles that we've written right here under recent posts. We've got, the history of Triple X Racing. That's my racing team. Money management YouTube. What happens to IRS debt when you die? Can the IRS seize my car? How a virtual assistant can help you survive COVID-19. So for example, if I was just going to go and look on something for S Corp status, we can find things about, electing S Corp status and late filing relief, S Corp automobile deduction, S Corp home office deduction. So if you want to know about setting your business up to be an S Corp and doing it late, then, you can find out all that information over here. All this information or similar posts do exist on our YouTube channel. So let me just go back here. If you were to come to the bottom of any of the pages, all of our socials are listed down here. So you'll be, if they apply, like some of these we do not have, but our Facebook, our X, I don't know where Twitter is. I know it's on the main, sorry, not Twitter, TikTok. It's on the main page. And then for the YouTube channel, if you come over here, we have all our videos. So these are videos that are being recommended for me for your 25 tax season. Do I need to file a tax return? If you're in business, get more customers with these 10 creative tips. Our 100 days of tax tips when we were doing them in video format are here. We are not doing video for this year, but you can look at any of this. Will you go to jail for not filing a tax return? So you might be going to the pokey. Any of the other videos that we've got, our most recent videos, these are our popular videos: mailing taxes the right way, how to file back tax returns, how to set up your IRS transcript account via ID.me, how to fill out and issue a Form 1099 NEC, self-employed tax tutorial. So we have lots of resources over here if you're interested in those. So feel free to come over, to our YouTube channel and check that out. All right. So that brings us to the end of the presentation. My contact information is listed right here. As a client, if you have any questions, you want to email us, the best email to do that is through clients@wilsonrogers.net. Our website, YouTube, Facebook, and the blog are all listed right there. Once again, office hours, we'll be moving to season office hours on the 27th. So we are here and available to assist you. If you have any questions, go ahead, feel free to hover into the chat window and you can type those there. I will look right quick. And doesn't seem like we have any additional, questions or anything like that. So with that being said, it's been my pleasure to give you this tax update. Hopefully you found it beneficial. Feel free to share it with your friends, pass it along. Maybe they can get something from it. And other than that, here's to a eventful 2025 tax season for tax year 2024. And we'll talk to everybody soon. Take care.